$3.5 billion. That is the trading volume Synthetix facilitated in just the first 9 days of their Season 2 competition. That is massive demand. But if you look at the price, we are sitting at 48 cents. Absolute depression levels. The market is completely ignoring what is happening under the hood. Most people see a dead token making lower lows. I see a protocol that is about to fundamentally change its infrastructure while sitting in a historical accumulation zone. If you are waiting for green candles to pay attention, you are already too late. Today, I'm going to show you why the upcoming Ethereum Mainnet Launch might be the catalyst we have been waiting for, and exactly how I'm positioning myself for this setup. Let's look at where we actually are. Right now, SNX is trading around 47 to 48 cents. If you zoom out, this is technically all-time low territory relative to the last cycle. The sentiment? It is worse than bearish. It is apathetic. People have given up. And I get it. We have been in a downtrend since 2021. But here is why this video matters today. We are seeing a massive disconnect between price action and protocol activity. Usually, when usage spikes, price follows. Right now, usage is exploding, but price is lagging. That divergence is where opportunity lives. We have major fundamental upgrades rolling out in less than a week that could force the market to reevaluate this asset. But before we get excited about the upside, we have to respect the trend. The chart is ugly, and I'll show you exactly where the danger zones are in a minute. But first, you need to understand the fundamental shift happening on December 17th. So, what's the spark? Synthetix is officially deploying Perps on Ethereum Mainnet. After a long time focusing on Layer 2s, they are coming home. On December 17th, the canonical Perp DEX of Ethereum goes live. This is not just a software update. It's a liquidity event. They are launching with support for Bitcoin, Ethereum, and Solana. Why does this matter for the token? Because SUSD and SNX are becoming the heart of this engine again. With over 50% of SNX staked and treasury-funded buybacks in play, they are trying to align the token value with the protocol's success. And they are not launching this into a void. They have been stress testing their systems with this Season 2 trading competition. I mentioned the volume earlier, $3.5 billion in 9 days. That proves there is real organic demand for their product. Traders are actively using it. They are also introducing something called Wick Insurance. This is actually a really clever feature. You know those scam wicks where price crashes 20% in a minute and then instantly recovers, but you get liquidated? Wick Insurance protects you from that. If you have it enabled, your position freezes during those volatile anomalies. If the price recovers, you survive. It is designed for the unfairness of crypto markets. So you have a product that traders actually want, massive volume proving the concept, and a deployment on the most liquid chain in the world happening in days. Fundamentally, the engine is revving. Now, let's see if the chart agrees.
I'm looking at the SNX USD pair on the 2-week time frame. This is the macro view. The first thing you have to notice is this orange descending channel. This structure has been respecting price action all the way from the top in 2021. Every time we hit the top of the channel, we reject. Every time we hit the bottom, we bounce. Recently, back in October, price rallied up to $2.50. That was a perfect rejection off the top of the channel, which also coincided with the 618 Fibonacci level. If you were watching my updates back then, you know we took profit there. It was a textbook play. But now, we have bled all the way back down. We are currently trading below the 10, 21, 55, and 100 exponential moving averages. The trend is undeniably down. However, we are entering what I call the load zone. This is the green box on my chart, ranging from 35 to 60 cents. This is where value investors step in. Let's talk Fibonacci levels. I'm anchoring my retracement from the local top of $3.70 in December 2024 down to 35 cents. Why 35 cents? Because that is the lower support of this descending channel. Since the price action is weak, I'm assuming we might wick down there to test that bottom trend line. If we look at the indicators, the Heikin-Ashi RSI has crossed neutral to the downside. It is not oversold yet, which suggests we could see a little more bleeding or sideways chop before a reversal. Synthetix needs a strong, green weekly candle to invalidate this momentum. But look at the volume profile on the left. The point of control, the price level with the most traded volume, is sitting up at $2.65. That level acts like a magnet. Price hates leaving efficient areas of volume for too long. The fact that we are this far away from the point of control suggests that eventually a mean reversion is likely. Now, my strategy. I'm accumulating in this 35 to 60 cents range. This is the zone where the risk to reward makes sense to me. For my stop loss, I'm watching the bottom of the channel closely. If we get a weekly candle close below 30 cents, that is my invalidation. I'm not interested in holding a bag that falls out of a 4-year structure. It does not mean the project is dead, but it means my trade setup is wrong, and I'll cut it to protect capital. On the upside, I have specific targets. If we bounce here, my first take profit is at $1.15. That is the 236 level. Next is $1.60, then $2.40. If we get a full bull run mania, I'll look toward $3.70 and eventually $5.70. I use a trailing stop approach. Once we hit target 1, I move my stop to my entry. Hit target 2, stop moves to target 1. We lock in gains as we go. So here is the game plan. We are betting on a convergence of factors. We have a technical retest of a multi-year channel support, combined with the fundamental catalyst of the mainnet launch. The risk is clear. The crypto market is weak, and if Bitcoin dumps, SNX could easily flush to that 30-cent level. That is why the stop loss is non-negotiable. Do not marry the bag. But the reward? If we just return to the middle of the channel or that point of control, we are talking about a 3 to 5x return from these levels. The asymmetry is there. If you are new to DeFi and all this talk of staking, yield, and on-chain metrics feels a bit overwhelming, I actually break down exactly how to navigate these ecosystems in my DeFi guide. It covers everything from liquidity provision to managing risk on platforms like this. It is in the pinned comment and costs $4.99 if you want to fast-track your learning. Back to SNX, my outlook is cautious accumulation. I'm buying the fear, but I'm keeping a tight leash on the risk. Synthetix is doing everything right fundamentally, while the price does everything wrong technically. Usually, that tension snaps in favor of the fundamentals eventually, but you have to survive the volatility first. I'm betting that the mainnet launch is the turning point, but I'm letting the chart tell me when to leave if I'm wrong. If you want to track this setup with me in real time, come join the Telegram community. I post my chart updates and market analysis there way faster than I can make these videos. The link is in the pinned comment. And if you are looking for other undervalued setups, I covered another infrastructure play recently that is showing similar signs of bottoming. Check that video right here on your screen. Thanks for watching, never financial advice, and I'll see you soon in the next one.